George, thank you very much. And you know, when I gave someone my presentation to read in the office, they said, "Lorne, you made a typo. It's value investing." And I said, "No, it was value investing." But then I ordered George's book, and I started reading it on the weekend. And I said, "You know what? It's not value investing. It's actually about values, because values are part of value investing." And so I'll just give you a brief chat today. It's just an open chat, and you know, about our values, our firm's principles, our disciplines to investing, our biases, which we all have, and George points that out in his book quite well, the importance of time horizon and how that has changed for me. A brief chat about our valuation methods, far less detailed than what I see on the board over here. And I'll look at kind of how we look at risk and portfolio management with a couple of simple examples. So I'm a lover of quotes, and the first quote here is from George, which is part of the intro of his book, before you get in there, which describes values of value investors: patience, discipline, humility, and a long-term perspective. I have to say, for me, I think the most important word here is humility, because in the investment business, we are constantly making mistakes. We have to answer to clients, which is not always easy. And no matter how long you are in this business, I truly believe the longer I'm in it, the less I know. The second part relates to biases, which is, as George again mentioned in his book, we all think we're smarter than we are. Now, this is from a famous person whose initials are AA, not GA. AA is Anna Abbandonato, who is my wife, who regularly points out to me that I'm not as smart as I think I am. So I'm not a fancy PowerPoint guy, as you will all see from this presentation. So when we come to our investment, our own investment, and this is just our own principles, and there are many smart people in the investment business, I am not one of them, but many people look at the world and specialize in certain things. For us, it is so important to focus on knowing what we don't know. And what I mean by that is, in 1994, I went to the first Mexican investment conference in Mexico City, including a meeting in the Mexican White House. I met a whole bunch of Mexican large companies, including CEMEX, CIFRA, and a whole bunch of them. I wrote a 50-page research report that was about to get published, but before I left Mexico City, I met a couple of American investors who had been working for a large investment firm there for a long time. They said, "Lorne, this is what I love about Mexico. We don't have the same rules that we do in the States. Because here there's no Chinese walls. Investment bankers are allowed to tell the trading desk what they're doing, and so there's all kinds of information, and it's all legal here." And here I was ready to write this 50-page research report on all these Mexican companies that I had seen. And I realized that what do I really know about how Mexican markets work? And when we look at China, the second largest economy in the world, the same thing is true. If you look at Alibaba, Chinese tech companies, the government often has a huge impact on what they do. And so we ourselves made a decision that we're only going to focus on developed markets, because while we don't know anything perfectly, we feel that we'll be able to add more value there. I also challenge people to give me more than one or two world-class companies that are headquartered in a non-developed market. I can't really think of any, and even in China, the reason that some of these companies exist is because North American companies aren't allowed in. So Alphabet is not allowed to go into China. Very importantly, in the investment business, and for all investors, it is very easy to get caught up in the everybody owns this stock, I don't, maybe I should own it. Certainly my clients will feel happier if I didn't. And one of our disciplines is, I better be able to explain to myself and to every client, why do I own this, as opposed to I own it because it's always going up. An example today is NVIDIA, a fantastic company, great chip maker. Our answer has to be, we missed it. We didn't own it, but I can't buy it now because there's just too much good news built into the stock. Maybe management will keep on delivering this level of growth, but it's just too expensive for us, and we missed it. The same was true for Tesla, Research in Motion, which is BlackBerry, and Norton. If I don't have a rational reason for why I'm buying something and why I own it, that's enough. I'm just not going to be there, even if we don't look very smart for a long period of time. At least I have the discipline to be able to explain to people why I own something and why I don't. And boy, it's so easy to get caught up in the flavor of the day. This slide exists for part of the same reason, is that as a value investor, there will be times when we own things that no one wants to buy, and times when we don't own something that everyone wants to buy. I will give you a simple example. In 2009, when I started this business in 1989, the Nikkei index, the Japanese stock market, was trading around a level of 38,000. In 2009, it was about 10,000. Only major market down 75% over such a long period of time, 30 years. 20. So we were screening for, are there any classic Venn Graham companies that exist? Companies that if you take their cash, their working capital, their cash and accounts receivable, subtract all their liabilities, that number is greater than Starbucks. And also these companies, we wanted them to be profitable, free cash flowers. We had a list of about 250 companies. And of those 250, almost 200 were in Japan. Because Japan was simply the most ignored stock market in the world. In 1989, when I started this business, Japan was the hottest market in the world. Every firm, including the little one I worked for, had a Japan fund. Every single firm. Okay? By 2009, everyone was underweight in Japan, no one was investing in Japan. And so we ended up with a portfolio of 25 small cap Japanese companies, all of which, if you took their working capital and subtracted all of their liabilities, that number was greater than the stock market capitalization, which means I'm getting the entire company for free. How could that not be an amazing investment? I mentioned this to several people in my office building because there's CIBC in there and RBC and a bunch of other companies, and they all said, hey, Lorne, that sounds really great. These are investment professionals. I can't buy them because if I'm too far off my benchmark for too long a period of time, I'm going to be out of a job, but hey, good luck to you. So we owned these companies. They did nothing for the first couple of years. Then you may remember the Fukushima disaster in 2011, the tsunami that hit the Japanese nuclear. Guess what? The stock market fell over 20%. So all of these great companies that we found were now down another 20%. Some of them down even more. We bought some more. We lost a few clients along the way because CNN had the 24-hour news cycle going on, and Anderson Cooper was there in a raincoat or something, and that can happen. And it took a number of years until this market finally started catching on, and these companies finally started realizing their value, but you can be offside for a period of time. My worst year in this business was 1999. That was the year of the dot-coms and Nortel. And Nortel represented about a third of the Toronto stock market index, and the dot-coms maybe a third of the S&P 500. We only buy free cash flowing boring companies. We owned none of those companies. And 2001 to 2003 were great years for us. Except here's the problem. Because we didn't own Nortel or any of these companies, in 1999 we lost 1/6 of our clients who were hungry and desperate to own these companies. And I told my wife it was like imagine going to work and getting fired every day by an angry person. That is literally what it was like, and everyone was caught up in the mania. And these things will always happen. And there's a famous book written in the 19th century by a sociologist named Dr. Charles Mackay called Extraordinary Popular Delusions and the Madness of Crowds. It is about financial bubbles up until that point. This is part of humanity. We're all looking to make money. And everybody works hard, everybody is stressed. I'd like to make 25% a year and sit on the beach. I would too, but I haven't found a way to do it yet, although maybe George will tell us. So when we talk about behavioral finance and biases, it is very easy to get stuck in a stock that is not working out. Not working out to me doesn't mean stock price is down. Those Japanese stocks were down, I never worried about them. It means you own something where either you made a mistake or something going wrong in the business and you're seeing it going down. And now we're stuck in this situation of what do I do with it? So I have an advantage because I work with an investment committee. With a small committee of several people, so I do have colleagues there. And the worst investment our firm ever made was my own recommendation, JCPenney. The good part was, we bought it in 22, the real estate was worth a large chunk of the stock price. Bill Ackman came in and changed the entire company around. We sold part of it at 50, unfortunately kept it, and then things started going wrong. And the free cash flow became negative cash flow. I stubbornly wanted to stick with it. The stock was down to $13. There were articles in the Wall Street Journal about suppliers not wanting to supply JCPenney because they're worried they wouldn't get paid. And I finally decided, okay, I'm going to be smart. I'm going to go see a movie in the afternoon, which I did. And I told the investment committee, you decide. Just make a decision, add to it, keep it, sell it, but I'm out of this thing. And at least I was lucky enough to say I'm too close to this, I can't make an intelligent decision. By the time I got back from the movie, the stock was sold. And it eventually went bankrupt. And they made a great decision. But we're all human beings and we just are all stuck with who we are. This is part of human nature and we at least have to recognize it. And that decision, led to our principle in our firm, coined by one of my colleagues. It's that we need to start every day with a blank sheet of paper. Just because I own a stock should have nothing to do with whether I want to own it today. It's, would I buy the stock today? If I wouldn't buy the stock today because something has gone wrong, then I need to sell the stock today. Because it would be irrational. Why would I hold it and buy it for new clients if I shouldn't be holding it today? And so we decided then to start every day with a blank sheet of paper. And we recently had a situation about a year or so ago where we were faced with this. We owned Philips, the Dutch medical technology company. Perfectly good company. I can tell you the 10 reasons why we owned it, cheap value and everything else. Except out of left field, they make CPAP machines for people with sleep apnea. And a number of people were getting sick, a few died, and there was a problem with their CPAP machines. And they started getting sued by a bunch of US lawyers, and you can only imagine how that was going to turn out, and in this case, deservedly so. And we said, would I buy the stock today? I would never buy the stock today. No one would recommend the stock. We need to sell it today. And the great decision we made is we sold Philips at a 25% loss instead of a 75% loss. There's no shame for an investor selling a stock at a loss. The shame is writing it down based on hope. We are not here, we're not in the hope business. This has to be unemotional. And it reminds me of what I call Las Vegas syndrome. If someone's at the blackjack table and they're losing some money and their significant other says, honey, let's go get dinner now. You go ahead, I'll join you as soon as they break even. Probably not a good strategy. Now I will discuss time horizon, and I have to say, an amazing client of ours who built a successful public company in the UK, who is a Buddhist, told me many years ago, Lorne, my life as an investor is so much easier than it is for all my friends. And I think it's because I'm a Buddhist. I always invest with a 100-year time horizon, and sometimes things work out early. Because when you have a 100-year time horizon, who cares about the next presidential election? Who cares whether there'll be a recession coming up 2 years from now? Fed raising interest rates, I've seen them go up and down a number of times in my career. hasn't affected most of the companies that we invest in. And you just forget about all of this short-term noise and focus on owning really good businesses that can stand the test of time. Many value investors are readers. I am a reader. And one of the great historians, husband and wife team actually, Will and Ariel Durant, wrote this big 10-volume set called Civilization. And Will Durant said many years ago, he said, most of us spend too much time focused on the last 24 hours and not enough time focused on the last 6,000 years. If you look throughout long-term history, everything that we've seen from politicians, from political movements to recessions, depressions, this happened 100 times. There have been hundreds of Donald Trumps over the last number of centuries, and there will be more. This is all related to human nature. We need to forget about it, and as soon as we forget about what's going to happen next year, life becomes so much easier. I sleep so much better at night. Now I can focus on the companies that I own. And that's where we as value investors really need to focus. So when we talk about valuation, unfortunately, there is no real formula. First of all, different industries have different metrics. The retail industry is very different from the banking industry or the insurance industry. And so we really need to delve into each industry and each company on its own merits. I will say one of the things I have learned for us, and this is part of our discipline, is that when I come to work every day, I have the biggest investment mistakes I've ever made in my career sitting on my desk. Piece of paper to remind me. The good part about them was I was right, these were all cheap stocks. However, they all had one thing in common, they all had too much debt. And when you have too much debt, and there's suddenly a recession, industry conditions are bad, management makes a mistake, you don't survive. So for us, quality, which is not a mathematical term, is a critical part of every investment we make. We want to own quality businesses. From the financial side, all of these companies are strong financially, which means they can survive a rough patch. Part of that means most of them generate free excess cash flow, which simply means they make more money than they need to operate their business. And with that extra money, they can then deploy that into hopefully making good decisions, which is called capital allocation. They can pay dividends, they can buy other businesses to grow the value of the company, or buy back their own shares. And capital allocation is a critical part of what we're looking at when we look at management. How do we evaluate good management? Well, one of the ways is how does management take their excess capital and invest it? And I'll discuss that in a minute. But I'll tell you one company that's done a very poor job. It is, I think, the largest drug company in the US. It is Pfizer, famous company, and one of the COVID vaccines. Pfizer's share price today is roughly where it was 25 years ago. That in and of itself, okay, may or may not be a valid example. But Pfizer's market cap is about $165 billion. And the last decade or so, Pfizer spent over $100 billion on acquisitions. So even though they've spent over $100 billion in acquisitions, the share price hasn't moved, and if you look at the numbers, they haven't created any value for their shareholders. And so for us, that's an example that management's just done a good job. They're a profitable business. They're not going out of business, but they've allocated capital poorly. They would have done a much better job spending a lot more of that money buying back their own stock. The last thing on this page is no head scratchers. And this is what I've told the investment committee when someone said, gee, the stock is down. I don't know whether to add to it or to sell it. Okay, that's a bad question in our business. That to me is a head scratcher. I want to own companies that if the stock price goes down enough, under normal circumstances, I'm just happy to add to it. It was cheap at 100, it's at 70, should be more or less a no-brainer. If the stock price is down sharply and I don't want to add to it, it might mean there's something gone wrong with the business, and then it should be in my sell category. But part of it comes down to knowing what you own. And there's just a lot of companies that might be just too difficult to understand. No, we don't own Bitcoin, okay? And I'll give you another example. I went to my brother's engagement party. Now, my brother's been married for probably 30 years, maybe a little bit more. And I met a young couple from Vancouver who were telling me about this amazing coffee company that opens these great cafes. And they think it's a great investment. And I said, listen, let me not talk down to you, but let me explain to you, cafes are a dime a dozen. The barriers to getting into the cafe business are minimal. You rent a place, you have an espresso machine, some nice people behind the counter. So why would you want to invest in a coffee business when anybody and his brother could open a coffee business? And I walked away. Thankfully, I never met these people again because the company they were talking about is Starbucks. Okay? And it just goes to show you that there are no real barriers to entry in that business, but somehow Mr. Schultz was able to bring a different focus to that business and develop it over time. And sometimes we just miss things because we're thinking this way and someone else is thinking the other way. That's why whenever anyone says, Lord, please give me your 3 favorite stocks, I never give them to them, because I'll probably give them the wrong ones and they'll never talk to me again. Now, there's a lot of diverse opinion about the value of speaking with management, and George addresses that somewhat in his book. I have to say that I'm not a believer in speaking to management about their own company. First of all, the reason is anyone who got to the level of CEO is going to be a spectacular presenter. Now, I said CEO presentations look better than my first CV. I will tell you what. In my first CV, I had played squash 3 times in my life. And I applied for my first investment job, and I said, personal interest, I figure a lot of investment people play squash. Play squash. I get my first investment job, of course. Second week on the job, the CFO, Lorne Steinberg, comes up to me and says, Lorne, I see you play squash. We're missing a 4th guy for doubles tonight. You're playing. Now, I hadn't touched a squash racket in 10 years, and the Steinberg family is not even known for their athletic ability. So we played double squash. Of course, I could not hit a ball the entire evening, literally. The managing partner wasn't talking to me by the end of the night. And the CFO walked up to me at the end of the evening and he said, Lorne, I have a question for you. Sure. What else did you lie about in your CV? Now, the next day I took squash lessons, but playing ever since. But anyone who's a CEO is a brilliant presenter. They wouldn't have gotten there if they weren't. And also, it relates to behavioral finance and our own biases. Do I honestly think I can evaluate another human being in a 1-hour? I will tell you, I cannot. There is a value for us in speaking to management, but it is the following. If I ask these people about industry issues, they're free to speak openly to me. They're not confined by insider rules and all the rest of that. A lot of these people have worked for competitors, and they'll freely talk about their competitors, and we can start to put together some information about the industry. But in terms about speaking about their own company, I take that with a grain of salt, and I don't want to end up getting sold by a phenomenal salesperson. So that's our view of speaking management. I can also understand that for small cap companies, for very small businesses, where the CEO and maybe one other person are really the drivers of the business, there could be more value if you get to know them and really understand them, and I certainly accept that. Because for a large cap company, I mean, if they're managed well, they'll have a whole bench of people who can do the job. Now, in talking about valuation, and of course, in life we always learn more from our mistakes than our successes. Looking at the balance sheet, it's great to say, okay, here's the balance sheet, here are the assets. I mentioned Dialex and JCPenney. JCPenney I slightly addressed before. Dialex, most of you, probably none of you ever heard of it before. Dialex was a Canadian retailer controlled by the Posmans family in Canada, and they owned Tip Top Tailors and a couple of other chains. Okay. So I was a young analyst and I said, hey, this is a great Ben Graham story. I can buy the current assets, the working capital, at less than the market valuation and get the whole company for free. And I was correct. There was one problem, as I learned. In the retail business, inventory is a huge part of the current assets. So I'll close the tab. And they weren't blind. Here's what they paid for their inventory. And if the company's going to survive, they'll take their inventory and sell it at double the price, or whatever they do. And the inventory is worth 100 cents on the dollar. The problem is, for any retail chain, if the company goes bankrupt, which means it's no longer a going concern, well, guess what? That inventory is now maybe worth 10 cents on the dollar. So here I thought that, okay, I've done all my homework, here's all my models. And it turns out Dialex went bankrupt, and suddenly the dollar per share of net asset value is worth about 5 cents. And I ended up losing 90% of our money. So it's not good enough just to read the financial statement. You really have to understand the different lines in the financial statement. So I call this growth, and this is an eternal struggle, Megan. This is an eternal struggle in the value investors world of how do I value growth, because there has to be a value for growth. And it's very, very tough. It'd be great if I could buy every great company in the world, or enough of them, at their less than their tangible book value, and get the growth for free, but I can't. So I said, this is addressed to Ben Graham, who's not around. But Ben, you're not in Kansas anymore. Ben Graham is very focused on really the net asset values. And we have to focus as well on, there has to be a value for growth. Of course, if I try to estimate that, I'm guessing. So we have to look at management's track record of the company, evaluate the business, evaluate the profit margin, the return on the invested capital. Every dollar they're making, what are they getting when they reinvest that money? And the balance sheet. And I find I rarely see an analyst, a Wall Street analyst, talk about the balance sheet of any company. And it bothers me because if you look at some companies, they might have 50% of their debt against their value. In other words, they're using leverage, they're using debt, nothing wrong with that if it's done responsibly. But then you have another company that has no debt and has net cash. Now they could just as easily lever themselves up a little bit, buy back some stock, increase their earnings per share, but they don't. But there has to be a value for a stronger balance sheet. And so there's no perfect way of doing this, and we don't want to pay too much for a growing company, but we own some companies who have some growth, and we try to put a relatively low valuation on that growth, but we don't want to ignore those businesses. And I can give you a couple of examples at any time, but I'll tell you, Starbucks is one of them. Right, and it's just an unbelievable, a company growing its earnings and revenues at over 10% a year with tons of free cash flow, financing themselves through their own internally generated cash flow. It's a very high margin business, and they have a pretty unique customer, because the Starbucks customer, unlike the Tim Hortons customer, if you raise the price of a pumpkin spice chai latte from $7 to $7.40, their customers don't seem to care. That's a pretty valuable customer. So, and it's funny, I just watched a little video of Charlie Munger before coming over, and he said something that Charlie Munger and Warren Buffett have talked about before, and a number of value managers have talked before. In fact, this little interview with Charlie Munger said, I'd rather have a 4 to 5 stock portfolio than own 100 stocks. And I thought to myself, okay, Berkshire Hathaway doesn't actually have a 4 to 5 stock portfolio. Neither does Prem Watson, okay? Respect the people. They have other businesses and many different things. But there's a quote from someone, again, probably none of you have ever heard of before, Bill Miller. Bill Miller worked at a firm called Legg Mason. He is the brilliant guy. He was the only mutual fund manager in history whose performance beat the S&P 500 each single year for 15 consecutive years. No one has ever come close to that track record. It was amazing. And of course, each year he would beat the S&P 500. Year 5, started tracking more and more assets. By 2007, Bill Miller had over $50 billion of assets. He was super smart. Then the financial crisis hit, and suddenly Bill Miller's funds were down over 80%. So you had $1 million on Monday, and you woke up one day and you had $200,000. And Bill Miller's portfolios collapsed. It didn't mean that Bill Miller was stupid, but what it certainly meant is Bill Miller ran very concentrated portfolios. And that works really well when you're on the right side of things. But when you're on the wrong side of things, you end up losing everything. And to me, there is a lesson there. And the fellow who I mentioned earlier with the 100-year time horizon said to me when I started in this business, Lorne, you're going to manage money for a living. You don't have to be overly smart. Now, I'm not sure if he said that because I wasn't overly smart. But he said there's a lot of smart people who had great performance for a number of years, attracted a ton of money, and then blew up. And Bill Miller is one example. The famous long-term capital management is another example. He said, so being smart really isn't a core criteria. Having good judgment is a critical criteria. And having good judgment means being able to look at ourselves and say, okay, we know we're not smart because George told me that we think we're smarter than we are. And so did my wife. So therefore, I'm also conservative, by the way, so you have to know who you are. And also in our firm, everyone who works in our firm has to have the same portfolio as our clients. No one's allowed to buy another stock. So, hey, this is my own life savings here. It's not a game. And so we have a 40 to 50 stock portfolio. I'm not saying you shouldn't have a 20 stock portfolio or a 10 stock portfolio. I'm saying this is I am conservative. There's lots of great companies out there, and we need to have some diversification, including among different industries. There's no perfect answer to this question, okay? I don't need to own necessarily, 10 bank stocks in my portfolio. That's not really diversification. We need to have some diversification because when you're 23 years old and you have $1,000, making 8% is of no interest to you. Of course, you want to triple your money every 6 months and get rich. The only time I ever bought an option in my life was in my first year in the investment business. I bought an option. It was either predicting the Japanese yen was going to go up against the Canadian dollar or go down against the Canadian dollar. I don't remember which. I only remember that I lost all my money, and it's the last option I ever bought. Because I thought, hey, look at the leverage you can get by owning an option. So when people get to a certain level of wealth, you work for 20 years or whatever, it's great that you want to do better, but you also don't want to go backwards. You certainly don't want to find yourself working at Walmart when you're 75 years old. So this describes our philosophy, but I'm certainly not saying other people have different ideas which are probably truly valid, and maybe we have excess diversification, but this is just who we are. I thought I'd just give you a couple of stock examples. This is a stock I've owned for probably in our firm for 15 years. It is Allstate. Property casualty insurance. One thing I like about Allstate, it's an incredibly simple business model. They will insure your home or your car in North America. They're not in emerging markets, they stick to what they do, and management has always favored profits over growth. So the insurance business can be competitive, and if an insurance company is getting very aggressive and offering you a better price on your car insurance, and you're an Allstate customer, Allstate will very often say, you know what, go to the other guy because we think you're going to lose money on that insurance policy. So PIF is policies in force. So in 2023, Allstate just decided there's some other aggressive competitors. We're just going to let some of our customers go elsewhere, but we're going to stick to what pricing on. One thing I like about the property casualty insurance business is it's a great business because you get to reprice it every single year. Hey, I'll give you a car insurance or home insurance rate for 1 year. If I found out the weather was bad, we're losing too much money in Toronto with too many car thefts, guess what? I can jack up your price the next year. So I'm not locking myself into a long-term contract.
That is.
Thank you, Joe. So Allstate, talk about capital allocation. 20 years ago, Allstate had over 700 million shares outstanding. 10 years ago, they had about 450 million shares outstanding, and today they have a little over 260 million shares outstanding. That means Allstate has bought back about 2/3 of its stock over the last 20 years. We've never sold a share, so by my calculations, 20 years from now, if the stock price never goes up and Allstate profits remain where they are, I will be the last remaining shareholder of Allstate. And this reminds me of a stock that Warren Buffett owns, that we own as well, which is American Express. In Berkshire Hathaway's annual meeting 2 years ago, Warren Buffett illustrated this point. He said, Berkshire Hathaway bought its last share of American Express in 1998. And at that moment, we owned 11.2% of American Express. We never bought another share again, and now we own 20% of American Express because they kept on buying back their stock, and Berkshire's ownership just kept on going up. So I look at a company like Allstate, if the interest rates go up, it's positive. It honestly doesn't matter because they'll just reprice their policies every year based on what they're earning on their float. No different from everyone else in the insurance business, including Vermont or Berkshire Hathaway. The price remains pretty cheap, the dividend keeps on going up, and at the worst moment in time for financial companies, the financial crisis, Allstate had a strong enough balance sheet that they never had to raise equity. They did not have to issue stock, they were able to survive the worst, which tells you something. Now, I'll just tell you about a company that we decided not to buy. Now, I think you pronounce this Rent-A-Kill, and it sounds like a hitman operation, but they're actually in the pest control business. They're the largest company in pest control in the world. They're a British company, but they're in North America. They've had a long-term track record of steady profit margins. There's a lot of really tiny businesses, and they've acquired those tiny businesses over time, cut the cost, improve the value. Good free cash flow growth, what's not to like? So our analyst came to me and said, Rent-A-Kill, this is within the last 2 years, Rent-A-Kill is making a gargantuan, a massive acquisition of their largest competitor. In order to make that acquisition, they have to issue a whole bunch of stock to dilute shareholders, but look at the presentation from management. Hey, we're making this acquisition, we're going to cut costs here, we're going to get all these synergies out of all of this stuff, and we're going to end up with higher profits per share. And all the Wall Street analysts were basically parroting exactly the same thing. Hey, as if this acquisition's already happened and everything will go exactly as planned. And the reality is, so many companies, including Pfizer that I mentioned earlier, have made these huge acquisitions based on a whole bunch of assumptions, and very often those assumptions don't work out. And second of all, we're not crazy about companies that have to issue more shares to grow. We want companies that are able to grow from their free cash flow. And so we decided not to buy this company. And it reminded me of my father-in-law, Carmine Abandonatto, who came to this country at the age of 13, never graduated from high school, worked in the construction business, bought a property, had some tenants, was going to buy another one, and a couple of people he knew who were lawyers and accountants said, rather than buy that boring income property, if we buy this land over here, we think this land will get rezoned over the next few years, the government will buy it out, and we're going to make, 10 times our money. And my father-in-law, who never went to George's class, said, that doesn't make any sense to me. If I buy an income property, I know my income. I know my return if the price is cheap enough. Basically, I'm a value investor. I don't want to buy something based on a whole bunch of things having to work out. And that's really what we're trying to do. We're trying to stay rational at all times and not get caught up in the other way. Thank you very much.
Thank you very much. Okay, we got 20 minutes for Q&A. Don't be shy. Okay, Sally.
Yes, I have a question. You just you bought go around and you set the sell order. How much the percentage go down?
Sorry, for which stock?
Huh?
For which stock do you remember?
Any stock if go wrong.
Oh, if it goes wrong. So
Yeah,
you know what?
yeah.
There's no answer. So let me. It's a great question. So a stock closes at companies usually issue their relevant news after the market closes. So I'll give you an example of a stock I own called Merck, the famous pharmaceutical company. Okay. One day after the market closed, Merck announced that they had a drug called Vioxx, which a muscle relaxant drug had led to several deaths. So I don't remember the stock price, but the stock closed on, let's say, Tuesday night at $50, and it opened the next day at $25. It's not as if I could get out of this in between. So there's no number, but for us, it's as soon as, if we wouldn't own a stock like Philips, maybe we were down 25% on Philips, I don't remember. But it doesn't matter, this news has come out, I know I would never buy it today, I'm selling it. Because I can't even estimate the value. So for us, taking a 25% loss in the investment business on a single stock of 50 stocks, rounding error, I don't care. What we're trying to do is not end up with a 90% loss. We're trying, now we own financially sound businesses, so it is doubtful that will happen, but you know what? Life has a way of playing strange tricks on us. The financial crisis came along and suddenly Canadian bank stocks fell 50%. British bank stocks fell more. And so we need to, there's no number. The question is, here's the price today. And I have to evaluate, do I want to buy the stock today at this price? If I don't, I need to sell it no matter how much money I've lost.
I have a question. So you mentioned this kind of 25 Japanese stocks you bought years ago. Like, what's the main message you're trying to say?
What is the message?
Yeah.
Well, the message is that no one was buying Japanese stocks. And
Okay.
certainly no one was buying small cap Japanese stocks.
Right.
And so just because they were cheap, they kept on going down. That's message number one. Okay, just because they're cheap doesn't mean it has to go up. The second part of the message is they were going down and the stock market was going up. And so as an investment firm, we are underperforming our benchmark and our peers by more and more over a longer and longer period of time. And for us, we need to stick to it because we know they're cheap stocks, but you can end up losing clients
But you're saying it's keep going down because of the tsunami, right?
it went down the tsunami took the Japanese market down, but there was no interest in Japanese stocks. And there was, and it's somewhat like recently, when, the large cap technology stocks are gathering up all the money. So if, the S&P 500 is a market weighted index. So the top, my numbers are wrong, but let's say the top 25 stocks might be almost half the index or, something like that. So all of this money from everyone is just flowing into these stocks. Well, if they're flowing into those stocks, either they're selling everything else or not buying everything else, and so everything else is standing still. And there's a whole bunch of people saying to me, Lorne, is it a bad time to invest because the stock market's expensive? I said, there are some stocks that are expensive, but there's a whole bunch of other stocks that are cheaper than they were 3 years ago. A whole bunch of consumer product stocks, Canadian bank stocks have done others, a whole bunch of stocks that have done nothing or gone down. So like any other time, there are parts of the stock market that are expensive, and there are parts that are not. And as a value investor, we need to have the fortitude to be able to say, I know that no one cares about this section of the stock market. No one cares. They're all boring. It's like they don't exist anymore. The only thing that exists is technology. Now is the time. The time to buy these is when no one cares about them. Because if you wait until they're back in favor again, they're going to be up again. And this is what happens in every single cycle. One day someone wakes up and says, you know what, these stocks are really expensive, or earnings start getting below expectations because expectations are priced in at just perfection. And suddenly someone says, hey, look at this, I can get a 5% dividend on a really good business that is growing, and it's only selling at 10 times earnings. That's a simplistic example.
But what happened to those Japanese stocks? Like,
Well, what happened was eventually, first of all, a couple of them got taken over.
Oh,
Okay, and then of course now recently the Japanese stock market's gone back up. So the Japanese stock market finally is back in favor again. And so, and let me say, those 25 stocks were not the world's best companies. They were just so incredibly cheap. But, so we weren't expecting to sell them at 20 times earnings plus, the value of working capital. We exited all of them in the last 3 years. Kind of they're fully enough priced.
So you talked about Pfizer, Merck, right? Those pharmaceutical companies, and I mean the pharmaceutical business, they are many times franchise business, which means they have some kind of remote, right? And they've got a product pipeline. In the case of Pfizer, the management's been like pumping $125 billion worth of all these, acquisitions, and George told us 4 out of 5 of them actually failed globally, right? In the case of Merck, the Vioxx, right, where again,
Vioxx was an accident. It was an accident.
You went in there with a thesis that somehow there'll be a catalyst that's going to bring it up, that Vioxx brought it down.
Vioxx was an accident.
Yeah.
Pfizer was an allocation.
Now, so I bought a stock in Biogen around the sort of the COVID time, back in March 2020. And, the expectation was there's going to be some catalyst. And Adalimumab, the Alzheimer's drug, really shot it up. And then obviously we found out from the FDA that, it was a big mistake. How do you identify those value traps? You have a thesis, yet...
Great question. So first of all, I'm a political science undergrad. I know zero about science or pharmaceuticals, and I know zero about a lot of things. Let me say, and I used to go to New Jersey, which is the headquarters of a lot of those drug companies, okay, including Pfizer and J&J. And the heads of research and development for those companies are very open. They have a portfolio of probably thousands of molecules. And as they narrow, their goal is to narrow them down and figure out which have the best shot at becoming a real drug. If I were going to buy one of those companies, I'd rather buy one of the larger companies because I'm buying the whole portfolio rather than buying a single biotech company that's making a bet on a single drug. It's in phase 1. Drug companies have to go through phase 1, preclinical phase 1, 2, and 3. Okay, phase 1 basically, does your drug kill mice? Okay, it doesn't kill mice, you pass level 1. Okay, so no one can predict, will this drug get to the point of being marketed? And even when it gets to being marketed, the FDA labels drugs. Okay, so you may not get the labeling you want. You thought you were going to have it for 1 million people, it's for 100,000 people. But the drug business has just gotten a lot tougher for a couple of reasons. One is when Pfizer or anybody else used to release a new drug in the 90s, they could raise the price by 10% a year. Okay? Now drug prices are controlled. The US is the only place in the world where the government doesn't control drug prices. And even in the US, it's controlled by HMOs and PBMs and these other items. So now you raise drugs by 2% a year. Second of all, the FDA wants companies very focused on developing new therapies that are going to be revolutionary. So they will not allow you to spend a lot of money and time developing what they call me-too drugs, a drug that's like 2% better than that. The drug business has gotten way tougher. I know nothing about it, but when we look at an industry, it's such a hit and miss industry. Would I have known that Ozempic, as an example, how do you even begin to predict that? And now there's like 5 other Ozempics that they're all like suddenly, everybody's going to make me, down to 112 pounds. If they could grow me to 6'2", even better. But there's so much. It's just a very difficult industry. It is hard, and then when the drug does come out, the stock price shoots up overnight, and then you missed it. It's damned if you do and damned if you don't. So I don't. It's a good question, and listen, there are lots of bright industry animals. Let me be clear, there are bright firms that invest in drug companies. It's not a large part of what we do because it's just in the too hard pile. That's my honest answer. Like it's so hard. And also, of course, drugs get a patent for a dozen years or something. So, Pfizer's had Lipitor. Lipitor was the largest selling drug in the world. $12 billion a year at its peak, but it's off patent. And so it's just a tough industry. For us, smarter people will do well.
You mentioned that money is sucking into large cap. So as a value
Large cap tech.
Yes, that's large cap tech. So as a value investor, industry sector should we look into this point?
So first of all, I didn't say there's no value in large cap tech. We have a diversified portfolio. And let me tell you something, in Charlie Munger, there was a one-page or half-page article in the Financial Times of London a number of years ago. And Charlie Munger was asked a really good question, which was, what do you do if you own a really great company and the stock price has really moved up and it's not cheap? It's no longer cheap. And Charlie Munger's answer was, I don't really want to sell a really great company because I have a long-term time horizon. So my answer is I close my eyes. I recognize it might drop 20% for a moment in time, but I want to hold it for 50 years. We own Microsoft. We bought Microsoft about 14 years ago or so. It was 12 times earnings. Steve Ballmer was running it. Revenues were flat. Earnings were flat. There was no growth. And today, we still own Microsoft. We've trimmed it back a couple of times, let me say. And I told someone, here's the question in portfolio quality. I feel that Microsoft is possibly the best or one of the best companies that we own. And I hesitate to sell it completely because I'm worried that we're going to reduce the quality of our portfolio, even though I am the first to acknowledge. I tell clients, Microsoft may be the same price 5 years ago as it is today. And the earnings will catch up over time, and I accept that. But I've learned that I sleep better at night owning really good quality businesses. So I'll tell you consumer, I'll just give you some names. Please do not buy these stocks, okay? But, an example is consumer stocks have done zero or gone down. So, a company like Diageo, which you may or may not know, Diageo bought the Seagram's brands many years ago. They have almost most of the famous brands of Scotch whiskey and Kettle One vodka and Johnny Walkers, and their genius has been, there used to be Johnny Walker Red and Black. If you go to the LCBO, you'll see Johnny Walker Red and Black. Then you'll see Johnny Walker Green, Blue, and Gold. They just keep on, hey, I can find people to spend $200. I'll have Johnny Walker Yellow. And they focused on premium brands and upselling Kettle One vodka and all of these, higher end things. That's their business. Earnings down last year, you know, they were free cash flow forever, a dividend increaser forever. Stock price is down, but the same is true for so many consumer products companies. Money has come out of that area. As an example, it's just not there. And because money has just flowed into one area for the last number of years. And you speak to a bunch of people and they feel, hey, why should I'll just own technology and nothing else. Whereas, you know, I sat at a conference about 10 years ago and the consumer product stocks were all flying high, selling at 25 times earnings, and every one of them those stocks. That is the history of our business. And so we need to have some of our money in that which is not doing well if the companies are doing well. We are business owners. And as a business owner, I don't value my business based on what someone will pay me today versus yesterday. We look at our revenues and our earnings and our cash flow. And the businesses that we invest in, we have to look at their revenues, their earnings, and their cash flow.
Do you or your companies invest international stocks or just based US or Canada?
No, we invest in Japanese stocks, European stocks, but we don't invest in emerging. We don't invest in emerging ones. We have one Taiwanese stock, which is Taiwan Semiconductor, as an example. But we do not invest in emerging markets because we know we don't have the expertise. We're going to get ourselves in trouble. And we get ourselves in trouble in enough areas where we think we have some expertise. We don't want to look in areas where we know we have no expertise.
I was wondering if, obviously you have a pretty diversified portfolio, when you're deciding how much to put into a position, what is considered a lot, what's considered a little bit?
Great question. So first of all, Peter Lynch was, a famous Fidelity fund manager back in the 80s and 90s. Peter Lynch made a comment, and I thought it was a really good comment. He says, you really don't follow a company well until you own some shares. And I swear, I think he's right. So even though we do research and everything else, until you actually have your money in the okay, now I'm really following this thing. So we tend to start off with a 1% position, just to give you an idea, give ourselves room to add to it, get to know it over time. The largest position, we don't want to have a position larger than 6% in the portfolio. And this is just, like I said, and this reflects my own conservative nature, okay, which is why I'll never be a billionaire. Okay, I met Ted Rogers back in the day. And, in order to become a billionaire in those days, like I said to myself, how can a guy like Ted Rogers already has so much money, borrow tons of money, and risk a large part of his company to get even bigger? I don't have that in me. Okay, but Ted Rogers had it in him, and also an engaging and bright and very nice guy who I see has his name on the school. But honestly, let me just tell you that Ted Rogers, for Halloween, I'm from Montreal, but my daughter, when she was young, someone said, hey, go to Ted Rogers' house for Halloween. So we were done Vegas Street, so we walked along, and Ted Rogers opened his house up to all the kids in the neighborhood, anyone else who dropped by. He had a butler handing out the best candy in town. I want to think about, Ted Rogers is an amazing guy, so we're not here, we're here trying to manage risk. We're here trying to minimize risk. So even Microsoft, how do I know that someone else, two guys in a garage in Silicon Valley or in Barrie, Ontario, won't suddenly have something that displaces Windows, and suddenly, this Microsoft that I said I've owned for all this time runs into a serious problem? That could just happen to anybody. So we tend to start off with a small position.
Sorry, I want to ask you a question on your ideas on investment in goods family controlled business. For example, RTO's biggest competitors in US, like Rollins, right? And it's controlled by Rollins family, and it is the biggest player in pretty much fragment industry, and a good operator and good capital allocator. And if that company at a good price will buy it,
You mean because it's family controlled?
Yeah, so basically, ruling family, I think, control like 40% of the voting rights.
And if Prem Watson were in this room, we would have an interesting discussion, let me say, okay? And we actually own Fairfax, so let me just disclose that. We've owned Fairfax for a number of years. But we still have an interesting discussion, okay? Because I'm not crazy about companies that have two classes of shares. I'm not saying we'll never own them, I'm not crazy about them. And you are very dependent on the family. Some families will be very hands-off. An example is the Molson family. And Molson Coors, they are not operators. They haven't operated that business for years. They hire independent, we don't know the stockholders, but we know the family. They've hired outside management forever, and the family they're just on the board level. They have no control. They don't want to exercise control. They're there for the long haul. Whereas other companies have had less of a good track record, but also not shareholder. Some companies are just not shareholder friendly. I'm going to name one in this room, which is a Canadian family, which was not shareholder friendly, which was the Shaw family. Rogers bought Shaw. Let me tell you, when you read the proxy statement of the Shaw family, it was just taking out so much money out of that company, way above what management would pay management, that it wasn't fair, in my view. And so I'll simply say every situation is different. We have to read the proxy statement to understand. Listen, I'll tell you, we have to vote our proxies. If you know what proxies are, we get to vote on stock option plans. And I will tell you, we vote against stock option plans basically just about all the time, because stock options, first of all, the stock market goes up over time. So even if you've not done a great job and the stock market went up, executives can make zillions of dollars on stock options. And does it really align their interest to that of a long-term shareholder? I'd rather they were paid based on cash flow and earnings and growth over time. So, we have to pay attention to these things. And we speak to management teams about that. And boards of directors, like that's part of our role, is to at least let them know that and this is becoming a larger thing over time. And in the press right now is Tesla. Elon Musk is trying to get a $50 billion pay package that is passed. It was the bulk of it, I think, based on the fact that Tesla stock hit a certain price within a certain time. I mean, to me, this is insanity. And how does that align a long-term shareholder with the fact that Tesla shares hit a certain price at a moment in time? But it's part of our research job.
Your last question? Anybody last question? One last one. Okay, Pierre.
Well, it's a very easy one. You seem to be a reader.
Yes.
Beside the Ben Graham, our prof's book, and so what would you recommend us to improve our thinking and become a better
Here's
investor?
my answer. If you look at my bookshelf, it's mostly non-business books. Okay? Most of my bookshelf, I just not long ago read a biography of Chairman Mao. I read a book on the opium wars in China, and one of the things I learned is because how did China get to where it is today? China was invaded over the last few hundred years, by the British. There's a whole history as to how things developed. So I realize it, but I also read novels. I find you just learn, you just open your mind up to different. So much of this is we're bombarded with too much information. And one of the things we have to do as an analyst is figure out what to read and what not to read. Because if I could spend my whole life reading research reports on Microsoft. Every Wall Street firm falls by, I could sit here for the rest of my life reading them and bored of them. But, we have to figure out what not to read and how to try and remove ourselves from what we're reading and think independently.